After World War II, pension systems were designed for large families, young populations, and retirements lasting roughly a decade. Today, fertility is below replacement across nearly every developed economy. Life expectancy has risen by more than a decade, and the ratio of workers to retirees is narrowing everywhere. The retirement system was built for a world that no longer exists, and it starts with a mechanism most people misunderstand. A widespread belief exists that workers pay into a personal account, storing up their own earnings for their eventual retirement. In reality, most public pension systems operate on a pay-as-you-go framework, where current tax contributions directly fund the benefits of those already retired. Money flows in from active payrolls and immediately flows out to beneficiaries, leaving only limited reserves to buffer against economic shifts. For this intergenerational transfer to remain stable, it requires a large, continuous base of active workers to support each individual retiree. The core vulnerability of this arrangement lies in a gradual demographic imbalance rather than a sudden failure. Because these institutions do not rely on fully funded personal assets, their health depends entirely on the ratio of contributors to beneficiaries. When the population age structure shifts, leaving fewer active employees to sustain a growing cohort of retirees, the baseline math of the system begins to work against itself. The pressure builds when this structural balance moves permanently away from the conditions that created it. In the mid-20th century, this design logic aligned closely with global demographics. When major economies established or expanded their pay-as-you-go pension systems in the decades following the Second World War, they did so under population conditions that made the model highly stable. United Nations historical data show that during the 1950s, total fertility rates across these countries hovered between 3 and 4 children per woman. This high birth rate created a broad, expanding base of young contributors at the bottom of the age pyramid, ensuring an abundant flow of new payroll taxes to support the retired generation. The post-war generation served as the critical unseen foundation, supplying the workforce with more than enough active contributors to make the system feel natural and permanently sustainable. At the same time, the period of retirement itself was comparatively short. Although life expectancy was rising, most individuals who reached the statutory retirement age, typically set between 60 and 65, could expect to draw benefits for an average of roughly 10 years. The calculation was straightforward. A large, growing workforce supported a relatively small, stable group of retirees for a limited window of time. This post-war population structure meant that pension systems did not require massive accumulated reserves to remain solvent. The sheer volume of active workers relative to beneficiaries kept contribution rates low and benefits secure. The entire system rested on a demographic bargain that was entirely rational for its era. Ultimately, this framework was tuned to a specific historical window, a younger, expanding world rather than a timeless population pattern. The baseline math that once sustained pay-as-you-go systems has dissolved. The primary driver is a widespread decline in fertility, which has dropped far below the replacement level of 2.1 children per woman across developed economies. United Nations data shows global fertility has halved since the 1950s. Rates in Japan and Germany have settled around 1.4 and 1.5, while South Korea has fallen to 1.09, shrinking the future pool of contributors. At the same time, longer life expectancy has extended the period over which benefits must be paid. Average life expectancy at birth across OECD nations has risen by more than a decade since the 1950s, reaching over 81 years. Today's retirees can expect to draw pensions for an average of 21 years. This imbalance is measured through the old age dependency ratio, tracking retirees per 100 working age adults. In Japan, this ratio stands at 54 and is projected to hit 80 by 2050. Germany's ratio has reached 41, while the United States sits at 31. Consequently, the worker-to-retiree ratio is thinning. The OECD-wide average is projected to drop from 3 workers per retiree today to just 1.5 by the late 2080s. Increased employment among older workers, such as the 56% of those aged 60 to 64 who remain active in the labor market, helps at the margin but does not cancel the wider shift. The system did not suddenly fail. The demographic assumptions behind it changed. This demographic shift alters national budgets today. In the United States, the 2026 Social Security Trustees Report projects that the main retirement fund will deplete its reserves by 2032, leaving 78% of benefits payable. Germany is bracing for an accelerating wave of retirements as its old age dependency ratio climbs towards 60% by mid-century. Yet Germany still trails Japan, where the demographic trend is most advanced, with seniors already making up nearly 30% of the population. Meanwhile, Italy represents one of the highest pressure environments in the developed world, with public pension spending consuming 16% of gross domestic product. While these nations share a common demographic trajectory, their institutional structures, domestic policies, and the precise timing of their fiscal stress vary significantly. South Korea presents the most compressed timeline of this transition, where the fertility rate has fallen to 1.09, forcing its National Pension Service to project a rapid doubling of its dependency ratio. Other nations attempt to buffer these pressures through alternative structural designs. Canada relies on a partially funded, globally diversified investment model with a statutory retirement age of 67. Australia combines a modest public safety net with a mandatory private superannuation system, keeping its public pension spending at just 4% of gross domestic product. Yet, despite these distinct structural frameworks and varying retirement age baselines, the underlying demographic direction remains identical. Whether relying on deep private asset pools or state-managed funds, every system must ultimately adapt to a shrinking base of younger contributors supporting a growing, longer-lived population. The fiscal stress extends past retirement funds to reshape the broader public balance sheet. As populations age, public health expenditure rises by an average of 2.6% annually across developed economies, putting immediate pressure on state budgets. At the same time, a shrinking pool of younger workers limits labor supply, which can constrain long-term economic growth. This demographic transition directly affects workforce output. Empirical data indicates that a 10% increase in the share of the population over 60 reduces labor productivity per worker by 4.95 percentage points. These compounding factors limit government budget flexibility, forcing a difficult trade-off between pension commitments, healthcare costs, and other public investments. Consequently, total age-related fiscal pressure is projected to exceed 12% of potential gross domestic product by 2060. Even housing markets feel the shift as demand moves away from larger family homes toward accessible, senior-friendly housing. Stabilizing these systems requires choices from a finite menu of policy levers, where every adjustment shifts cost or risk to a different group. Raising statutory retirement ages reflects longer life expectancies, but the physical reality falls heavily on manual laborers compared to white-collar professionals. Increasing payroll tax contributions brings in immediate revenue, yet it raises labor costs for businesses and reduces disposable income for workers. Lowering future benefit payouts improves state balance sheets by transferring financial risk directly to future retirees. Secondary measures, like incentivizing late-life employment or expanding targeted immigration, provide partial relief but depend on public support and economic integration. Long-term productivity gains through automation and education offer a slower, harder path. None of these options eliminate the demographic burden. They simply relocate it. Today, the demographic math of the 21st century is forcing a global reckoning. Retirement itself is not disappearing, but the post-war institutions supporting it must inevitably change. How we adapt will define the social contract for generations to come. Share your perspective on this transition in the comments below. Every crisis begins as a crack, small enough to ignore until it isn't.